In a recent video, I was asked as to why buying puts is a safer option than selling shorts. Um, the idea here is essentially the idea of unlimited risk, which is what you expose yourself to when you short a stock. I'm going to show you an example and it'll make everything a lot more clear than if I just explain it in academic terms. So let's look at a stock that I'm thinking of shorting. Budweiser. Or Bush. It's Bud. I don't even know what this is. I don't care too much about the company. But I think it's a beer company. I don't drink American beer, so I wouldn't know. But there you go. It's Bud. Okay, so let's imagine I short this stock. Let's look at the monthly chart. And let's switch to the candlesticks. And there you go. Now I'm thinking of shorting this. And I'm not going to short it outright. If I short it outright, I expose myself to unlimited risk. I'll tell you why. When you short a stock, what you do is you borrow shares and you sell them immediately in hopes that in the future the stock price will be lower and you can repurchase the stock at a lower price. So if everything goes as planned, you'll make money. And here's an example. Let's say I short 100 shares of Bud. And right now, Bud is trading at 112. Let's say I hit my price target. I haven't decided my price target yet, but let's say I hit a price target, and my price target is $100. All right. In that case, what happens is it drops from 112 to 100. How much money did I make? Well, I made $12 per share, multiplied by 100. That's $1,200 in profit. That's great. But what happens if things don't go as planned? What happens if this company tomorrow announces that they've invented a beer that can cure cancer and AIDS? Well, wouldn't that be great? It'd be great for humanity and the company, but it wouldn't be great for you because the stock would shoot up and there'd be a huge gap. You'd have no time to cover your short, and you would see the stock perhaps go up to $1,000 a share. Now, how much money do you lose? Well, you have to buy back the shares. Your brokerage is going to see that your short has gone awry, and they're going to do what's called a margin call, and they're going to say, hey, you got to put more money in the brokerage, but you'll probably have to declare bankruptcy or something like that if something goes like I just said. So the idea there is that when you short a stock, there's really nothing stopping the stock from jumping way higher, and your brokerage forcing you to buy the stock back at a huge loss. Now, if the stock jumps up from 112 to 500, how much money did you lose? Well, you lost almost $400 per share, multiplied by 100. That's $40,000 you lost on one trade. Now, we can limit our risk, and even if Bud invents cancer-curing beer, we don't have to spend $40,000 buying back the stock. Our risk is limited by the price of the put option. So let me show you an example. Here's a put option. Here's a list of put options, and we're just going to choose, we'll just choose the most popular one. All right. So the most popular one we choose by arranging them by open interest, and the most popular put option is this one. Now, the cost of this put option is $167. But what you get when you buy this put option is you get to mimic, I click on it, you get to mimic having 100 shares short on the stock to a degree. And that degree is called delta. So here our delta is negative 35. So in a way we're mimicking, you can just multiply this we'll put a decimal in front of it and multiply it by 100, and that's essentially the amount you've shorted. So essentially we're shorting 35 shares of stock. So let's say we want to get delta to 100, which would be mimicking shorting 100 shares of stock, then we just buy 3 of these, right? So we buy 3 of these. Now the cost is going to be this times 3. So we're spending roughly $450 to $500 to mimic shorting 100 shares. So if things go the way we planned them to go, and Bud drops from 112 to 110, we get the same profit as if we had shorted the stock. That is, we got $1,200 on a investment of about $500. However, if things go awry and the stock jumps up to 500, how much do we lose? Well, the value of these three options will go to zero. So we've lost $500. We've lost our entire investment, but we didn't lose anything more than that. As you can see here, we have a max risk. The max risk per option is only about $200, whereas the max risk for shorting stock is going to be unlimited, theoretically unlimited. Of course, there is a limit, but theoretically it's unlimited, and you expose yourself to a amount of risk that you probably don't want to expose yourself to unless you're very sure that the company is going to go down and not go up to a certain degree. Well, I think that explains it pretty well. Obviously, if it sounds too good to be true, it must be too good to be true. So why do put options, why are they so great compared to short selling, and what's the catch? Well, the catch has to do with this theta value you see. You can consider this as the amount of money that the option decreases per day. So unlike stock, where there is no time decay, or where the stock is always the stock, there's no difference, the option has an expiration date. So if you hold on to the option and Bud does not go down, you're losing money. But if you hold on to the stock, if you shorted the stock and Bud does not go down, actually you're still losing money because you have to pay interest on the shares you borrowed, but you're really not losing that much money at all. So it can trend sideways for a while and you're pretty much safe, but if it trends sideways on an option, you're spending money every day. Now we get into more complex option strategies where you can actually make this theta zero, and I teach that in some of my courses, and I think I might have a video on it, I'm not sure. But overall, options are going to be better when you're shorting a stock. When you think that the asset's going to go downward, you're probably going to want to go with a put option rather than shorting the stock outright, because it limits risk. And you don't need to worry about this because I can show you ways to deal with theta. But overall, I think you get the idea. Unlimited risk is because of the fact that there's nothing stopping the stock from going all the way up and forcing you to buy it back at an insanely high price. But with a put option, the max you can lose is whatever you spent on the option. That's it. If this was helpful, please like and subscribe for more videos like this. And in the comments section below, if you have any questions, please leave them there and I'll make a video to answer your question just like this one.